Joining us right now is the founder, CEO, and chief investment strategist at Mainstay Capital Management, David Kudla. David, good to see you this morning. Thanks so much for being here.
Good morning, Maria.
So we've been talking about what a week this is. We've got fourth quarter earnings coming out. That's been pretty much driving the story. We've got a jobs report coming out at the end of the week on Friday. Brexit discussions, the vote today. U.S.-China discussions tomorrow. A fourth quarter GDP number. How do you want to invest with all of this?
We think investors should be looking at stocks right now that they want to own. We've been invested through the past month has been very good for stock investors. 13% rise through Friday from the lows of December 24th, and that's in both growth stocks and value stocks, so a broad market advance. We're going to see some give and take here now after this nice advance of the last month, but investors should be picking their points here, have their list out on stocks they want to own. We look for a good 2019 for stock investors.
Is it good news, John Hilsenrath, that the Fed gave us a pivot, that we know that the Fed is on pause right now, and that we know that they're even ready to consider slowing down the unwind of the bond portfolio?
Right. I don't think it's good news. I think it shows that the Fed is becoming less confident about how strong and sustainable the economy is. I mean, it is a sign that inflation isn't picking up, and that's good news. But you see some real trepidation coming out of the Fed right now with the global economy slowing, with the markets being unstable and volatile. I think the Fed is a little worried about the outlook, and that shouldn't really give us a lot of encouragement.
What about that, David? I mean, the economy is slowing.
Yeah. But, John, the important thing here is what happened in the fourth quarter is we had mixed messages out of Fed Chair Jerome Powell. We had on October 3rd, we were far away from neutral. Then by November, we were close to neutral rates. Then on the 16th in the Fed meeting, they were going to do what's right no matter what. Then he came in on January 4th and finally said, we're going to be considerate of market and economic conditions. And now we're seeing a more consistent and accommodative message out of the Fed, and that's very important for the markets. That's music to the market's ears, and that's why we've now seen this sustained advance. So the markets and investors are now looking at a Fed that seems as though they are going to be considerate of or accommodative or take into account what's happening with the markets, with the economy, and not just normalize rates for the sake of normalizing rates. They won't have $50 billion rolling off the balance sheet on autopilot, and they won't raise rates just to raise rates to get to a normalized rate structure. They will pause like in 2016 if the market and economy warrants it.
That was the worry in the fourth quarter, that they were on autopilot, John.
Right. So I'd make 2 points.
That drove the volatility in the fourth quarter, the Fed.
David makes a really important point. So this has been Jerome Powell's first year at the Fed. He's had a bit of a honeymoon with the market. I think what the market has discovered in the last month or two is that Mr. Powell, he kind of prides himself on being a plain-spoken communicator, but his communication has confused a lot of people in the market, and he's really had to do a lot of corrections over the last few weeks. So that raises some questions about him. But the other thing about, the market wants to see the Fed on an easier path. Okay, but the underlying message there is that this economy can't sustain very high rates. So it doesn't send a really encouraging message about economic growth and the economic outlook when we see that the Fed is starting to recognize it just can't sustain a tighter monetary policy.
But look, we're getting the news from the companies themselves. But John, the fourth quarter numbers coming out. Verizon just reported mixed earnings. They beat on earnings, but they missed on revenue. Technology reporting later today. Apple, and we heard from Apple already. Facebook, Amazon, all reporting this week. Microsoft. It's going to be a big week for technology. And, of course, you mentioned Caterpillar. That was the big kahuna yesterday that really set the tone for the markets, because Caterpillar is a great indicator of economic activity across the world, in particular China. So stay on earnings for a second, David. Give me your take on technology, because you've got Apple, Facebook, Amazon, and Microsoft coming out this week.
Well, tech stocks got beat up very bad in the fourth quarter. They've come back in this rally. And we think that tech stocks have further to go. Look, we think that investors should stay with tech stocks. We have an opportunity here to add value stocks to the portfolio. Cyclicals came into 2019 at their lowest valuation relative to the S&P 500 ever. So investors now can diversify their portfolio in an opportunistic way, holding both growth stocks, those tech stocks that we think still have some rebound and some further runway ahead of them, and by adding value stocks that are very opportunistic.
David, it's good to see you this morning. Thanks so much.